The global economy is in a tight position right now where just about everybody believes that we are either in a recession or heading towards a recession. So what does that mean for you, your portfolio, your family, everything? We'll talk about that today. The first thing is the yield curve chaos, something that I've been talking about over the years. The second thing is the economy and potentially peak inflation, at least what they're willing to report to us. And then we have the Fed data. I'm going to give you information directly from the Federal Reserve, and this is important because they're paying attention to it, which means it's going to affect their policy. All of that and more. The first thing I wanted to look at is right here. Global yield curve inverts and signal a recession is brewing. Now, you've probably heard of this before, but imagine the yield curve inversion is simply this. The way I like to explain it is that if you're going to take out a 30-year bond and you're going to take out a 3-month bond, if you're going to buy each of these things, wouldn't you expect that the 30-year would give you a better return and the 3-month will give you very little? But now that has kind of flipped. And so that's the yield curve inversion, okay? During these periods of time, it usually starts to signal that a recession is coming. It is as soon as that trend reverses that we tend to have a recession in, depends on the circumstances, but it could be a few months or could even be as much as 18 months after. So it's not necessarily telling us that tomorrow is going to be a recession, but it does give us an indication that has virtually perfect actual explanation for what occurs in the near future after. Fed speakers this week have pledged more monetary tightening. Germany may already be in a recession, according to Deutsche Bank. So as I said, Europe, US, all over the place, seeing the same situation. Global bonds joined US peers in a signaling a recession, with the gauge measuring a worldwide yield curve inverting for the first time in at least 2 decades. So I just wanted to make that clear that it's not just one. We're talking about this on a global scale. The average yield on sovereign debt maturing in 10 years or more has fallen below that of securities due in 1 to 3 years. That has never happened before based on data going back to the beginning of the millennium. Well, you can see it for yourself on this chart right here. This is just giving you an idea of what has happened. Since 2000 up until today, this has never happened. We have never seen this before. Now, we've gotten close, but never seen anything like it. And that tells us that we are in what, I want to use this word, unprecedented times. Truly, in this case here. Central bankers paralyzed by inflation fears will keep cash rates anchored in the restrictive zone for longer. This will be a key catalyst for ongoing curve flattening. And of course, you will see other central bankers coming out and saying, hey, we have to make sure that the inflation is going to stay down. And you know what that means. That means higher interest rates for longer. That means your mortgage rates are going to remain higher. That means you as the individual, you have to borrow at more expensive rates. And hopefully you don't need to borrow, but if you do, it's going to be pricier than what it was before. That's the whole point here. And you look at corporations. Why is this important? You're an investor perhaps. Your corporations that you own, even if that is a broad index, you indirectly own them, they are borrowing money all the time. Every company from Apple, which I showed you at the beginning, that was Apple's chart, Apple and basically everyone else, they borrow money even when they have so much cash on hand. They borrow that money at an interest rate. Now that has gone higher. Corporate debt is one very risky thing, particularly as we see these rates climbing. Okay, so there's more in there. Looking here at this Wall Street Journal article talking about the same issue. Yield curve inversion reaches new extremes. Unusual relationship between treasury yields reflects investors' bets on easing inflation and future rate cuts. Yields on longer-term U.S. treasuries have fallen further below those on short-term bonds than any time in decades. A sign that investors think the Federal Reserve is close to winning its inflation battle regardless of the cost to the economic activity. See, the belief is there. We don't have any evidence. We don't have any facts, but we have hope. That's what we're dealing with today. Okay? And so they get on with that. I think it's important just to know the basics in what we covered here today. Look, the market is saying, I think inflation is going to come down because the market needs that. They need that. And so that's really all it's about. It's not about actually bringing inflation down. It's just about believing that it will be down. Okay, it's a strange situation. Now, you look, there's clearly winners and losers, and you see where the areas today that are too expensive in many ways are not where people are moving. They're kind of deciding now's the time to get out. And in this case here, Dubai is the most sought after, where luxury real estate prices may rise and fall the most in 2023. Dubai is one of these places where you've got people from Russia coming out of there. You've got people from Europe coming out, and they are buying into Dubai. There's many reasons for that. Obviously, there's no corporate tax. There's no individual tax, no taxes, anything like this. And it is very open. There's so many reasons why money is being put there. That's very clear to understand. And they do not have a lot of the issues that people are really uncomfortable with in many places. So I wanted to talk about the next issue. As we break this down, I want you to think about what's happening on multiple levels, but also it depends on where you live. Let me show you here. U.S. Producer Price Freight Index. Now that has come down quite a bit, as you can see here, along with the CPI year over year. So of course, the freight index, what people are paying for freight, has declined. And we have seen that, and I'll show you some charts around this. This is important. This is actually a positive thing. It is positive to see how rates are not where they were at this peak. And look, if you got to import products, if you're one of these individuals, whether it is coming from raw materials or whether it's consumer goods, my goodness, it really has an impact on your margins. But again, good news, Goldman Sachs supply chain congestion scale, they seem to have created all different types of indicators, but it's on a scale from 1 to 10 at a 3 right now. So this is really good. But what does it signal? What does it tell us? Well, of course, the situation is that the demand isn't there. You see? The demand isn't there. That has a direct impact, of course, on the company's bottom lines. And if the companies are hurting, guess what they do? They lay people off. And if you stay into the end of the video, I'm going to show you how many people in the tech industry have been laid off. It's important to understand this. Our weekly composite declined significantly, minus 21% week over week. This is the bottleneck index, just showing us that this has been going on a trend here, and we are going back down to the levels we had a couple years ago. In a sense, it's good news, but it shows us what it signals is that the demand clearly isn't there. And here we have the different indexes just showing us, this is the composite container index. It's also showing us the freight rates, comparing, all the different areas, Los Angeles to Shanghai, Shanghai to Los Angeles, all these different things. And again, I've covered this many times before, these have declined. The only one that has risen is Rotterdam to New York. Okay, that's the only one. Big 3 West Coast ports inbound loaded containers, minus 23% year over year. All right, and then we get into Europe. The suggestion, my friends, for Germany right now is that the inflation rate maybe I'm going to put a big little asterisk on that, or just a big one, not a big little one. You could see it down month over month, minus 0.5. So I know, too early to tell because we've seen these before. You can see that there have been these dips, but only time is going to tell what happens with that. If we get this decline in economic activity, and by the way, we should see things picking up now. Now's the time of year when things get tighter, things get more expensive, things are harder to come by, and yet the congestion is slowing down, the demand is slowing down. I saw many reports of shopping malls and so on that were not busy at all. yeah, a lot of it's being done online, but in terms of, people being out and about, really lower than, where it would normally be. So let's look at what the Fed had to say. We need to understand what the Fed is doing because that's going to affect you, your mortgage, your credit card, everything. The Fed is tightening into a recession. The near-term forward spread is negative. Just showing this, they give all these kind of obscure details, but all you need to know is that the Fed is tightening into a recession. And you don't really get these things to happen too often because the Federal Reserve generally sees a recession coming and they start to loosen up. However, not this time around because of inflation, something they're not used to, being high, being higher than they would like. And they don't intend on actually quelling, or I should say, trying to tamper down this level of inflation. They've made that clear that, they're just going to end up letting it run hotter than where it should be. But the rates of Fed funds rate have gone to levels that most people said would be impossible. In 2020, everybody, central bankers, analysts, everybody in the industry, in the financial industry, was saying rates will remain at or near zero for basically ever. And then it was, not that long until they really changed their minds, it seems. Okay, now unemployment. I'll talk about this more in a second, but just want to show you when it comes to recession, I think of it being the result of an income shock. Back in the early 2000s, jobless claims were a very good indicator of that shock. Over a year's time, 50,000 or more people were filing initial unemployment insurance claims. 200,000 were collecting insurance. The loss of income was enough to trigger a cutback in spending that ended the recession. And they basically say, different scenario for jobs today, right? Really different. Because unemployment, look at where it is, super low. Jobless claims, yeah, they've climbed, but they're still much lower than where they were in 2020 and beyond. Regional Fed recession indicator, percentage of the Fed regional manufacturing indices, comparing a bunch of them, and just saying that, so many times before, when we get to these levels, a recession is on, or, it's coming and so on. That's where we're at today. This is the Philadelphia Fed indicator, puts US at recession risk. You can look at all these different indicators, okay? I'm not going to here to explain each and every detail in all of this. There's so many, and quite frankly, what we need to be searching for is what the Federal Reserve actions are. Are they tightening? Are they loosening? Are they stopping? Right now, they're still in a tightening cycle. The expectation is on the 14th that we will hear from the Federal Reserve that they will tighten less, but still in a tightening mode. The number of tech layoffs this year is nearing annual levels seen during the Great Recession. Really, big time. I mean, most people didn't expect this to happen. About 65,000 tech jobs were lost each year in 2008 and 2009 during the recession. Right now, 60,000 job cuts for this year. So it is, in fact, at the level of that, but not to the level of the dot-com boom and bust. I wanted to show you this. You can look at layoffs.fyi, layoffs tracker. If you type that into a search engine, you will get this, and you could see that there have been 140,000 layoffs for the tech industry as a whole, and this is in 2022. So that gives you an idea of what's happening in the tech industry altogether. And because you don't want to just see this in your own area, you want to look at it broadly, what's happening in the industry. And that is very clear, very important, to look at it all and try to make sense of it. What's happening? If the Federal Reserve is going to tighten, if other central banks are going to tighten, if we are in this mode and companies are expecting a recession, well then, a recession could be a self-fulfilling prophecy. What do you think? What are your expectations? I would really like to know. please post them in the comments below. I do read each and every comment. I want to thank you for your time today. Make sure you subscribe to the channel, and another video coming at you tomorrow. Take care.